Well, I'll tell you what what's happened, and we put the chart up on Twitter, is you're spiking the policy uncertainty index, right? So between tariffs and budgets and everything else. But what's interesting is policy uncertainty actually tends to be bullish, not bearish for equity markets. You know, we've talked about that before, but the chart is up. What's always interesting about sentiment is we always get pushback on sentiment because people try to attach the narrative and say how this time is different, right? And that's kind of what sentiment does. Like sentiment's not easy to invest with, right? I mean, because it's psychologically just the opposite of what everything in your gut is telling you should be doing. So you kind of have to train yourself to understand sentiment, to respect sentiment, and work against it. But you know, for those who are saying, yeah, this time is going to be different, I'm saying, look, any time can be different. There's no doubt about it. But it's to us the equivalent of taking a hit on a 19 at a blackjack table hoping for a 2, right? I mean, that's just not going to work as a long-term strategy. So if you think this time is different, that's fine. God bless you. But we certainly will be fading the fear as we look at this. Welcome to RenMac Off Script. We openly discuss markets, economics, policy, history, and life. It's the 28th of February, 2025. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
Most of the charts that we reference are going to be posted on our Twitter or LinkedIn account. So we'll get going. Neil, you look a little nervous. You on that Epstein list?
No.
All right.
I have, come on. Me?
You don't like to fly private, I know.
The last I checked, I mean, of the three of us on this call, you're the one that flies private. So.
Oh, hey now. All right. Well, let's start with some of these controversial things going on in the government. Forget the list, whatever that may hold. We have a budget deadline. I think it's the 14th. I believe that would be 2 weeks from today. Government shutdown, no government shutdown. Where do you come out on that, Steve?
Right. And I think last week I was about 35% for a shutdown. I think now maybe slightly to 40%. I think now that Republicans have got their budget resolution out of the way, at least in the House, that's sort of where the attention is over the next couple of weeks. And really, it's going to be on, I think, Democrats to decide what they want to do with Doge. I think you have demands to try to ensure that the Republican lawmakers are going to put some strings attached here to make sure that Trump and Elon Musk are spending funds as appropriated. I think there's some resistance amongst Republicans to doing that. Then the question is for Democrats, are you better off shutting down the government or not? I think both sides right now are trying to sort of assess with polling behind the scenes, some of the messages to feel are they going to be held more accountable than the other side. But there's also a practical element here, and that's Trump has a lot of leeway if the government shuts down. My guess is he's going to make sure that Musk and most of Doge is deemed essential. And they could potentially go into these agencies without a lot of the career people there that have been obstacles and potentially have free reign. So I don't know the Democrats want that. The fear, I would say, is if we do shut the government down, is it going to be a long? I think there's probably a case that it might well be, in the sense that when you have these sort of binary outcomes, that makes it difficult for the other side to sort of take a loss. If you're trying to look for political fig leaf to say, okay, what do I need to sort of make some concessions here and reopen the government? So that's sort of the fear that I would have if we get into that point. Keep in mind, though, we're talking about 2 weeks from Friday. That's important in the sense that you could technically go into a government shutdown on Saturday and not have really any noticeable effect until Monday. That's sort of what we saw, I believe, the most recent sort of standoff here in December. We just got a continuing resolution. At this point, though, there's not enough time to draft the full year spending bills. So really I think attention is going to be on, we're going to have some sort of stopgap measure. Is it basically just going to be through the end of the fiscal year, which is the end of September? It's trending more in that direction.
Well, I'll tell you what's happened, and we put the chart up on Twitter, is you're spiking the policy uncertainty index, right? So between tariffs and budgets and everything else. But what's interesting is policy uncertainty actually tends to be bullish, not bearish for equity markets. You know, we've talked about that before, but the chart is up. What's always interesting about sentiment is we always get pushback on sentiment because people try to attach the narrative and say how this time is different, right? And that's kind of what sentiment does. Like sentiment's not easy to invest with, right? I mean, because it's psychologically just the opposite of what everything in your gut is telling you should be doing. So you kind of have to train yourself to understand sentiment, to respect sentiment, and work against it. But for those who are saying, this time is going to be different, I'm saying, look, any time can be different. There's no doubt about it. But it's to us the equivalent of taking a hit on a 19 at a blackjack table, hoping for a 2, right? I mean, that's just not going to work as a long-term strategy. So if you think this time is different, that's fine. God bless you. But we certainly will be fading the fear as we look at this.
Is there a ex post issue with that, right? Like, so when you're in, I mean, because you don't know ex ante, like when the policy uncertainty index is going to stop rising. So are you, right? So policy uncertainty is rising at the moment, and it's not like stocks have been doing well. So, right? I mean, so it's
when you go from the kind of middle attitudes to the spike, it's bad news. But the good news is where we are right now at the top 20th percentile of historical readings. So we kind of look at that as, I mean, maybe you could set it off the charts in terms of uncertainty. It is an unlimited index. But if we look at the history of it and say, look, what happens in the top 20 percentile of all readings, it actually tends to be good news, particularly when it spikes. But you're absolutely right. If you're at the 50th percentile moving higher, that's not a great place to be for equities. It's when it spikes and finally gets up there and you kind of have the rate of change and the level. That's where it starts to get more interesting. Neil, we had Philly Fed last week. Kind of a bummer. I don't think that's a really important one for you, but you want to talk about that a little?
Didn't the Eagles win?
Oh boy. Wow.
I don't know. Shouldn't those people be happy up down there? I don't know. I mean,
I did see this. It was I think it was on a Twitter feed, but it was a Philly fan marrying a woman who's obviously presumptively a Philly fan at the whatever the parade, and she had the wedding dress on, and when she like lifted up her dress, she had an ankle bracelet of the incarceration type, right? So it was just a classic, nothing like kicking off your wedding day with an incarceration ankle bracelet.
Well, I just think it's interesting because there's a lot of chatter about how the soft data, which is what's, kind of been cracking of late. But the truth is that the hard data in January was already worse. So a lot of the soft data points have been out for February, and you've seen some slowing there. But, I mean, things have been getting worse even before then. I mean, if you look at January, retail sales, employment, home sales, both existing and resales, those are all worse than expected. Core shipments even were worse than expected. So it's like the hard data has already slowed somewhat. Maybe there's a feedback loop with what's going on with equity markets into sentiment data, or what's going on with policy uncertainty with respect to sentiment data. But I've been arguing for a while now that a lot of what we're seeing, people talk about policy uncertainty. I mean, the guy ran on tariff being his favorite word in the dictionary. Now you're
ran on policy uncertainty. That's exactly.
I mean,
right.
You can say that the tariffs are bad, but don't say that policy uncertainty is what's driving it. I mean, it's sort of I've always found these arguments to be sort of just very much lacking. And of course, it doesn't really work in the data the way you'd expect. I mean, if people are that worried about uncertainty, how come they've been how come business investment has generally been going up? Like if you look at core durable goods orders, they've been rising through January, even as uncertainty was rising. So I don't, there's no sort of neat and clean way that this kind of works in the data. I would just say that it's important to kind of look at just the data and kind of tune out some of the noise in DC. And what we know is that incomes have been slowing for months. Housing has been slowing for months. State and local government spending has been weakening for months, right? I mean, these were big tailwinds for growth in recent years, and they're all kind of going the other way, and that's what matters. I mean, to the extent that tariffs or the sequencing of what we're seeing is not favorable, that makes a bad situation worse. But really, I mean, what a lot of these people are talking about, I mean, what I find so pathetic, frankly, is just how people are using this as a reason to mark their forecast to market. It's been going on for a while. Now you realized. I mean, it's kind of sad in a way. But
well, it's the oldest problem in the book, right?
I mean, we've been doing
a narrative, and then
sell-side analysts, right? You're just using this as a crutch.
Yeah,
to
no doubt about it.
Something that's already been going on.
So where are you on single family construction, unsold homes? I mean, they're not good.
Worse.
Right.
I mean, all of these things are, I mean, unsold, single family unsold inventory is basically at a cycle high. If you look at the resale market, pending home sales, which represents signed contracts on resale houses, are at fresh lows. Because those represent signed contracts, obviously that's going to lead the overall data. New home sales also are weaker. That's going to, bleed into construction, obviously. So there's not much to like in the housing market. No doubt, Jeff, people are worried about tariffs, which is why they're not spent buying homes. Or maybe interest rates are too high and, policy is too tight. I mean, that's, I think, the primary reason. I mean, I'm just saying it kind of in jest.
Right.
But yeah, I mean, there's nothing to like about the housing market.
We have had a pretty significant contraction. I don't know, maybe 25 basis points or so. We're now right around 425 on the 10-year yield. Our target was 415. You've got a note out about, I think, personal income growth and the like, and kind of how today is different, almost the polar opposite of what people were talking about back in 2022. You want to hit that real quickly, what you're thinking?
Well, sure. I mean, so, back then, remember, we had this view that there wouldn't be, soft landing, hard landing. We made the argument that there wouldn't be a landing in 2023, no recession. And that was basically premised on the idea that income growth was strengthening. Remember, we had the big shock from Russia invading Ukraine. By the end of the year in 2022, gas prices had basically round trip. So we went into 2023 with a still solid labor market, people sitting on excess savings, and now real incomes rising as inflation was slowing down. Despite the Fed hiking, housing was finding a bottom. I mean, home building stocks had been rallying all through that fall into 2023. Governments were still spending a lot of money, and the consensus was thinking there would be a recession. So one of the ways you get a bad outcome is if you're not prepared for it. But if you are prepared for it and the bad outcome doesn't materialize, then the opposite tends to happen. You get this sort of catching up period. Now you fast forward to today, real incomes are getting worse, not better. There is no excess saving. The labor markets continue to cool. Despite Fed cuts, housing is getting worse. State and local government spending is continuing to slow down. And the consensus went into the year very buoyant on growth. No one was really expecting recession. So there's more room to be surprised on the downside than the upside. So, I think it's a pretty straightforward thing. What we're seeing in DC, I do think that that's very much like the tempest in the teapot. It's not as big of a deal as people are making it out to be. These things would be happening regardless. And to the extent that what we're seeing in the markets doesn't really reflect a growth scare, that means that there's more room for the markets to correct, arguably. I mean, if you haven't even had the growth scare part of it yet. So yeah, I mean, I'm cautious. I mean, I think the Fed is largely the reason for this. I mean, their policy is too tight, and that's weighing on a lot of credit sensitive areas of the economy. And so insofar as they're kind of waiting to do something, it creates passive tightening of policy, which makes growth that much worse. A friend of mine who's pretty active on X, Connor Sen, he basically made the observation, which I 100% agree with. I mean, I've been kind of alluding to it myself, but if Biden were still president, the Fed would be signaling cuts. Full stop, end of conversation. Okay. I don't, and I 100% agree with that. I mean, but I guess let's not talk about what higher corporate taxes mean for inflation. I don't think the Fed wants to have that conversation, but I just think it's, they're kind of picking and choosing, and it's unfortunate, frankly. But
well, from pulling the string on that and equating that to equity markets, home building stocks, anything that's kind of related, construction materials, those names have been weak now for, well, at least 6 months. I'd actually pressure to say it's probably closer to 9 months, pretty close to the peak that we saw with semiconductors, right? So there's another really pro-cyclical area. We lost ground transportation last week. This week we lost industrials last week, which we talked about. The good news is that discretionary is still holding up, so that'll be important. And I'll talk about staples a little bit, but the two areas that we'll be focused on to see if the mistake is actually materializing or growing some type of root system will be the performance of financials, which tend to do poorly because credit quality of assets goes down, and credit spreads. And so far, the good news for the Fed is that those two things are not yet seeing signs of stress, right? So I'm totally with you. We're seeing definitely at the margin the weight of some of these policies, and most of it's interest rate related in our view. And we'll see. I mean, 415, I think 375 is probably the level that starts to get things in a little bit better position from a growth standpoint. But obviously, you don't want to see the 2-year yield coming in dramatically, because it does suggest that the Fed's making a policy mistake. So let's talk a little bit about Staples, because Staples got overbought unequivocally in most of our work. We haven't changed at all the trend of the relative performance line. For those who know our work, we use overbought conditions in downtrends. It's a combination of some quantitative work that we've done to use those conditions as what we call an optimal exit. It's a point at which we think most of the near term has run out of gas, and the long-term trends are likely to come back in and prevail. And that's where we are on Staples, particularly in things like beverages, packaged foods, etc. For whatever reason, globally, the tobacco names look to be one of the stronger areas within Staples. So, as they say, smoke them if you got them. Neil, what's going on next week?
Well, next week,
wait, what am I doing? Hold on. Hold that thought.
Got to ask a question.
Yeah, the mailbag. Harry Chen's mailbag. Harry, what do we have this week?
Hello. I was wondering.
that was creepy.
So today we have the question from Drew. His question is, the president seems to want a few key pieces of economic to move simultaneously. He wants rates down, energy price down, inflation down, and tax down. In your opinion, which of these is he likely to get first, and which is less likely to happen at all? Thank you.
All right. Thank you, Harry. Did you get that, Neil?
Well, it seems like on the market stuff, he's getting all of these things more or less simultaneously. Rates are down, oil is down. The dollar has generally been down, although it's been rallying of late. I think a lot of that is just sort of tariff-related angst as we go through the weekend. The tax one is the one that's likely to come more towards the end of the year, I would assume. I mean, Steve could probably speak to that because he has to deal with Congress, which again gets me back on my soapbox about the uncertainty. Congress is thinly divided. The uncertainty would be there regardless, right? I mean, it's really about Congress, not so much what Trump is doing. But I think it's interesting, right? I mean, one of the things that I found very sort of interesting was just a few weeks ago. I mean, I think Kevin Hassett, the director of the National Economic Council, was doing an interview with CNBC, and they asked him, how do you plan to slow inflation down? And he basically looked right at the camera and said, weaker aggregate demand.
Whoa.
Well, it's just like anything else. I mean, there was a great you see these sort of like people on like CNN, he's not doing anything about inflation, and then it's like, well, but then Doge is supposed to be but then they throw their hands up in the air because Doge is supposed to be very disruptive, but then it's like, oh, well, not like that. He's not doing anything about inflation, but not like that. I mean, you know what I mean? It's just like he's not dealing with it in a way that you like.
So sequentially, how do you look at this? It's energy, it's inflation, it's rates. Which one? Where's the chicken? Where's the egg?
Well, energy.
Yeah,
I
would agree.
I think it's sort of a 1970s way of thinking about it, but okay. Trump has less influence over the tax stuff because he's not in Congress. But on foreign policy, I mean, if he's de-risking the world, that should be good for the for oil bears, right? I mean, that's what you'd expect. So, I mean,
well, you get that, and Steve, I want your opinion. You drive energy down, right? Which, frankly, of all these things that you have some control over, which is still tough, that's probably the one that you have most control over. You can't wave your magic wand and make inflation go down. You can't wave your magic wand and make the 10-year go down, right? You can obviously pressure the Fed to get things lower, but that's not necessarily going to help inflation. So I think absolutely the first one would be energy, and then the rest of them can follow from there. Steve, what's your sense on the taxes?
Well, first, I just want to agree on the energy, and I think we've talked about this before. You're not just speculating, like in theory, like he's actually doing this. We talked about him meeting with Vladimir Putin and Saudi Crown Prince Mohammed bin Salman, three of the largest energy producers. This relates to Ukraine, getting some sort of ceasefire there for that conflict. So yeah, I think that's probably the easiest and probably most likely to occur first. We also got a tweet from Jedi Trey who asked if Musk and Trump are using Doge cuts to raise the unemployment to make it easier for Powell to cut rates. I thought it was an interesting idea. That's probably more in Neil's lane. But I think one thing that you do also hear from President Trump administration is sort of the linking of energy prices to inflation. And so I think that will continue to be a priority. And to your point about Congress, yeah, I mean, that is obviously frustration for every president, I think, having to work with them. And my sense is that the tax cuts will probably come later in the year. I think seeing some progress from the House moving their budget resolution is a good first step. The devil's going to be in the details now. And, I think the thing to watch next week, is it possible, an encouraging sign would be next week if the Senate came in and actually voted to adopt the House budget resolution, because that would signal that the Senate's actually getting on board with there and maybe actually accelerate the timeline for getting something done, maybe more mid-year as opposed to December, which is when the tax cuts are scheduled to expire. At the end of the day, I don't think that Congress is going to let the tax increase go through. It's not really in anybody's interest. So at a minimum, you probably see at least a 1-year extension for Democrats. I could see an incentive to do that just to sort of prolong this political dynamic, that the tension between Republicans. Again, I don't think anybody wants to do that. But I think Neil may have alluded to this earlier, this idea that we're talking about basically extending current policy. So I think you're talking about more preventing a headwind as opposed to 8 years ago when you're providing a tailwind, and the sequencing there ahead of tariffs, reducing the corporate rate, lowering rates on top individuals. That might have made it a little easier to deal with some of the price uncertainty with some of the tariffs.
Yeah. All right, now Neil, what do you see next week?
Well, it's the first week of the month, so that means you're going to get a lot of data coming out. ISM will be a big one. There's been some evidence of stabilization in manufacturing, but obviously these are very much sentiment-driven indicators. So, just as quickly as the ISM went above 50, I could see it going back down again. Actual manufacturing activity remains quite sluggish, of course. And then we end the week with employment. Remember, January was a pretty weak month. We had not only slower jobs growth, but we also saw a slower work week. I'd expect the work week to bounce. I mean, maybe some of those weather-related factors kind of unwind, and that pushes up the work week a touch. That should come at the expense of hourly earnings, right? So you have more hours, you have the same earnings over those hours, and so as a result, hourly earnings slow down a little bit. And the consensus is looking for about 160,000 for February payrolls. Look, I mean, I think goods producing employment has been slowing. And I would just say that you leave Doge aside, at the margin, the anecdata on employment hasn't been great. I mean, Autodesk laying off 9% of its workforce, Starbucks doing a corporate restructuring, laying off 1,100 workers, not filling open positions. You saw some news out of Southwest Airlines with respect to corporate layoffs. So, at the margin, I mean, the layoff news has gotten somewhat worse, even controlling for the Doge headlines. And I think that's worth watching because you don't really need much in the way of layoffs to get some spooky jobs numbers because the hiring rate is very low. So that's sort of something that I'm keeping an eye on. And if the labor markets continue to slow down, that's going to speed the Fed up in terms of getting rates down again.
You're still in the camp for sure that the next move is down.
Yeah, I don't think the markets actually have adjusted enough. I mean, if I look at the futures market, it looks like fixed income's gotten in line with the Fed, which is 2 cuts this year, I think that that's probably not enough. I think they'll be doing at least another 1 or 2 more.
So we're going to look at, we'll be watching next week beta. And I say that because if you recall back on the 6th of December, our beta work, high versus low beta, got into the 99th percentile historically in terms of performance differentials, much, much higher than anything we saw out of momentum. And so what we've seen, and if you think about where beta resides, right, high beta really resided in industrials, high beta resided in tech. Where low beta resided was utilities and staples. We've gone from the 99th percentile to this week down to the 12th percentile. So clearly that reversion trade worked. We've seen, and we just talked about the strength in staples, the strength in utilities, and obviously the weakness enough to actually change trends on a relative basis in industrials, and then continued weakness in semiconductors, not so much in the other areas of tech, but certainly they have come in and gotten oversold. So that beta trade has worked. We're not yet at the point where we're willing to flip that trade, but certainly there are areas of it like the move that we've seen in staples that we think are certainly probably at the end of their road, if you will, in terms of the performance. So continue to watch beta as we go, and then just the big oversold condition in orange juice. You guys not drinking orange juice at the Dutta household anymore? What's going on over there?
We're not big orange juice drinkers, no.
Well, I'm not either, actually. I used to, but I don't do it anymore. How about you, Steve? You're a health buff.
Drink a lot of fruit juice, but not orange juice. But I guess just quickly for next week on the policy front, Tuesday is going to be a really important day. Trump's going to give a speech that's going to more or less be like a State of the Union address, although it's technically not when you make the first one. And usually that is a big signal for the legislative and just the administration's agenda as a whole. So seeing what priorities are actually mentioned probably gives you a sense as to their priority and also which ones are left out. So that's sort of a thing to watch on Tuesday. The other thing is you're going to have Tuesday are these tariff deadlines. Trump sort of reemphasizing earlier this week that he does plan to proceed with a 25% tariff on Mexico and Canada. Now, look, he used a lot of strong rhetoric the last time before he sort of sought to delay him again. If I had to assign a probability for tariffs on Canada and Mexico right now, I'd probably 35%. And I think what he caught the market maybe by surprise, and myself included, was when he was talking about not only reiterating his threat there, but also saying he's going to raise the existing tariff from 10% to 20% on all Chinese imports on Tuesday as well. I think there's some frustration that China has not come to the negotiating table. There may be some disagreement over the scope of it, what this conversation is going to be. China may prefer just a broader dialogue here, whereas Trump likes the idea, well, let's talk about this issue and then come back with another issue so we can keep sort of needling you as opposed to doing the whole enchilada. So I think that's sort of the thing to watch on Tuesday.
Yeah, planning to keep an eye on. Well, S&P support at 57.73. We'll see if we get there, but it's a good support level. So again, we're not seeing enough deterioration in some of the ancillary things to believe this is the beginning, at least at this point, of a bear market, just a correction. But in a non-momentum market, I mean, keep in mind, as we've talked about a couple times, the percentage of issues above their 20-day moving average still below 50%, as the market was very close to a new high. That's a tough thing to sustain. So we'll watch that. Thanks to Drew for his question, and really everybody for their questions. Great questions, guys. Keep that up. We look forward to answering those. So join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and LinkedIn. And if you want to watch this, subscribe to our YouTube channel, and you can see our beaming faces there. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.